Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullah. In this video, I'm going to discuss the material covered in chapter 13, which focuses mainly on the binomial tree. Now, the binomial tree model is the first option pricing model that we will be learning in our course. However, it's not the first model that was introduced to us. It came after the Black-Scholes-Merton model, which we will be discussing in chapter 15. However, we are covering it first here because it is much more intuitive and easy to follow the logic behind the model. So let's see what is this model about. Now, before we start, let's discuss quickly the definition of a model. Well, whenever we hear a model, what comes to our mind is that a model is a simplified representation of the reality in which it uses certain inputs to produce an output or a result. Now, this definition also applies on an option pricing model. Now, an option pricing model, it's a mathematical formula that we use to determine the price of an option or the theoretical fair value of an option by using the factors as an input to the model. And the objective of any option pricing model is to get the theoretical fair value. Now, we learned in chapter 11 that there are certain factors that affect the price of options, and these factors should be inputs in the model to help us determine the fair value of the option we are dealing with. Now, what's the idea behind the binomial option pricing model? The binomial option pricing model assumes that the price of the underlying asset, whether it's a stock or something else, follows a binomial distribution. What do we mean by it follows a binomial distribution? So it means that the asset price at each period where there will be trading either will move up or it will move down by a certain specified amount. Now, the binomial option pricing model helps us to determine the price of the option given certain characteristics of the stock or the underlying asset that we are dealing with, in addition to the characteristics of the option that we want to value. The version of the model that we will be learning in this course, because there are different versions of the binomial tree, is referred to sometimes as the Cox, Ross, and Rubinstein pricing model, because these three authors introduced the version that we are dealing with to us initially. Okay, now let's look at an extremely simple binomial model. In the setting of this model, let's assume that we are dealing with a stock that has a price currently of $20. So this is the price of the stock today. And the price of the stock, and let's assume that the stock will be, there will be no trading on the stock until after 3 months. And we know after 3 months that the possible prices this stock can take is either it will increase to 22 or it will decrease to 18. No other possible prices are available. No trading will happen in between. So this is the price today. After 3 months, either the price will go up or it will go down. And after that, there will be no trading on the stock. So this is an extremely unrealistic binomial tree. However, it helps us to understand the idea behind the binomial model. Now let's assume that there is an option that will mature or expire in 3 months on the stock with a strike price of 21. Now, if the price of the stock went up, and since we are dealing with a call option, the option will be in the money, because we know that the payoff is the maximum between S T minus K or 0. That's the payoff, right? Which is also the intrinsic value. Now, since the price of the stock is 22, then the call option is in the money and the payoff will be $1. If the stock price went down after 3 months, then the option payoff is going to be 0, because the option will be out of the money. Our objective of the binomial tree model is to get the price of the option today. We want to find the call option price today. Okay, how we can do this? Now, there are 2 methods. One is by setting up a riskless portfolio. Why would we want to set up a riskless portfolio? Well, we know that the price of the stock will either increase to 22 or decrease to 80. If we were successful in creating a portfolio that includes a long position in delta stocks and a short position in one call option, in a way, if the price of the stock went up or the price of the stock went down, the portfolio will have the same value. So how can we do this? Let's assume that I can create this portfolio by entering into delta, a long position in delta shares, and I will short one call option. And the value of the portfolio, if the price of the stock went up, is 22, the price of the stock, times the number of stocks I have, minus the payoff. Why minus the payoff? Because I took a short position, which means I'm going to pay the payoff. So the value of the portfolio will be 22 times delta minus 1. If the price of the stock went down, then the value of the portfolio is 18 times delta, and since the option is out of the money, we should ignore its value. Now, can I set a riskless portfolio? Well, what do you mean by a riskless portfolio? It means that whether the price went up or the price went down, then the portfolio will have the same value. Can we do this? Well, if we equate the value of the portfolio when the stock goes up to the value of the portfolio when the stock goes down, it will have this form. So 22 times delta minus 1 is equal to 18 times delta. Now delta here is just a factor. It's like an x or y or any other factors that we are dealing with. But we use delta here for a purpose. Now, since I set up the equation this way, now I solve for delta. So I take the unknowns in one side and the numbers in the other side. So we will have 22 delta minus 18 delta is equal to 1, which means 4 delta is equal to 1. That will lead us to delta is equal to 0.25. Now someone might say, well, this doesn't make sense. How can I buy a quarter of a share? Well, let's assume that for theoretical reasons that we can do this. Although recently, with the advancements in technology and the innovations in the financial industry, some brokers allow you to buy a fraction of a stock. Now, if we want to correct this to make it more realistic, we can just short 4 call options, and at that time delta is going to equal to 1, since the ratio is 4 to 1. So we can just short 4 call options, and delta at this case will equal to 1. Either case, we will have the same results. Now, let's just verify if delta was 0.25. Will we really have a riskless portfolio? Well, 22 times delta minus 1 is equal to what? So we will have 5.5 minus 1. That will give us 4.5. And 18 times delta will give us 4.5, which means the portfolio is, yes, truly riskless. Why did we say it's riskless? Well, since the value will not change no matter how the stock price will change, then isn't this what characterizes a riskless investment? A riskless investment. In a riskless investment, I know what will be the value that I will receive in the future. So here I know after 3 months I will receive 4.5 no matter what happens to the price of the stock. Okay, why this is important? Well, if I created a riskless portfolio and I want to find its value today, then this means I have to discount the price or the value of the portfolio. The difficult task we will always face when we are dealing with a risky asset is to determine what is the proper discount rate. The problem is we will always face disagreement among practitioners, among financial economists about what should be the proper discount rate for discounting any certain risky asset. When we created a riskless portfolio, we get rid of this problem. Why? Because if I am dealing with a riskless portfolio, then the value or the discount rate I should use is basically the risk-free rate. I should not demand a risk premium on investing in a riskless portfolio or risk-free portfolio. So setting up a riskless portfolio helped me with the problem of determining the proper discount rate. Here, no one will disagree that when we are dealing with a risk-free asset, we should use the risk-free rate. So I can find the present value or what will be the value of the portfolio today by discounting using the risk-free rate. Now let's assume that the risk-free rate is 4%. Now we know that the value of the portfolio is 4.5, which means the value of the portfolio today is 4.5 times e to the power of minus 0.4% times 3 over 12. That will make the value of the portfolio today is 4.455. Okay, we know that the portfolio includes a position in the long stock and a position in the call option, a short position in the call option. If I was able to find the value of the portfolio today, which is 4.455, and I know what is the value of the long position in the stock, it's 0.25 times 20, the price of the stock today, which we observe, right? Which equals to which equals to 5. Then can I get, if I know the value of the portfolio and I know the value of the long stock, can I get the value of the short call position today? Yes. So since the portfolio is equal to long stock, so delta S minus the premium I received in the call option. Remember, since I took a short position, I am going to receive the premium, so it's going to reduce the cost of the long stock. Then I can use these figures. 4.455 is equal to 5 minus C, which means the price of the call option is basically 5 minus 4.455, and we will get the price of the call option is 0.545. Okay. Now, if the price of the call option is something other than 0.545, then there is an arbitrage opportunity. So this setting here, we are pricing the option by relying on the no arbitrage price. If the price of the call option is different from 0.545, then there will be an arbitrage. Okay, and the forces of the arbitrage will push the price of the option to reach 0.545. Now let's move a little bit one step ahead by generalizing the one-step binomial tree. So instead of using numbers, we will now rely on symbols to make it more general. Well, the price of the underlying stock today is, as we know, is 0. If the price of the stock went up, then we will multiply S0 by the factor U. So to get the price of the stock when the price increases. If the price of the stock went down, then we will multiply S0 by the factor D to get what will be the price of the stock when the stock decreases, when the stock price decreases. The payoff of the option when the price of the stock increases is FU. The payoff of the option when the stock price decreases is FD. And the price of the current price of the stock, the current price of the option that we are targeting to find is, we will refer to it by F. Right. Now, how we can create a riskless portfolio when we have these symbols? Well, applying the same idea. Now, we will have a riskless portfolio if the price of the stock times delta minus FU. And why minus FU? Because we are paying the payoff when the price of the stock goes up. We are paying the payoff of the option. And when the price of the stock goes down, the payoff will be FD. And if it has a positive value, then we will also pay its payoff. So we will be able to create a riskless portfolio when we equate this value of the portfolio with this value of the portfolio. And remember, the portfolio consists of a long in delta stocks and a short in one derivative or a call option. Now the portfolio is riskless when this part is equal to this part, which means that delta is equal to the change in the payoff of the option divided by the change in the stock price. Now, does this delta looks familiar? when it has this format. Isn't this the formula for the slope? So the changes in the y divided by the changes in the x, which also measures the sensitivity of the option price. If you remember a little bit of the introductory math, you will recognize that yes, this is the slope formula or the sensitivity formula, which we will come to discuss later. Now, the value of the portfolio at time t, we choose one of the two values because both have the same value, they are equal when we created the riskless portfolio. So assume we choose one, and the value of the portfolio at time t is S0 times U times delta minus FU, which means the value of the portfolio today is S0 times U times delta minus FU, all discounted by multiplying by the discount factor, e to the power of minus RT. Also, we have another expression for the portfolio value today, which is S0 times delta minus F, right? If I want to construct the portfolio value, if I want to construct the portfolio today, I will pay S0 times delta minus the premium I received from shorting the option. Now, these two must be equal, which is S0 delta minus F is equal to S0 U delta minus FU times e to the power of minus RT. If they don't equal, then we will have an arbitrage opportunity. Doing some arrangements, we will reach that F is equal to S0 times delta minus the value of the portfolio discounted at time t. Okay? Now, let's define the variable p to equal to e to the power of RT minus d divided by u minus d. So, just a variable, we define it this way. And let's substitute for the value of p with the value in the value of f, or in the formula for f. So doing a little bit of algebra, okay, doing a little bit of algebra will lead us to the value of f equals to p times fu plus 1 minus p times fd, all times e to the power of minus RT. Now I want you to look carefully at this formula here. What does it tell us? It tells us that the value of the option today is a function of the payoff if the price of the stock went up, and the payoff of the price, payoff of the option when the stock price goes down, and all discounted. And each payoff is multiplied by a factor p, by this variable p. Doesn't this formula look familiar? If you guys remember from statistics or from portfolio management course, that sometimes we can calculate the expected value by multiplying a probability times the value at a certain scenario plus 1 minus that probability times the other scenario times the value of the something that we are looking at the other scenario, assuming that we only have two possible scenarios. So isn't this looks like we are getting the expected value of the payoff of the option payoff, and then we are discounting it to get the price of the option? if that's the case, then this means that P is a probability. However, is really P a probability? Well, P is a factor that I calculated by myself. So it is not really a probability, but it acts as a probability. Now, it turns out that this P has a very crucial function. What is this function? It transforms us from a world where investors are risk averse, which is the real world, into a world where investors are risk neutral. So another name for P is the risk neutral measure, or the probability of an up movement of the stock in the risk neutral world, not the actual world, not the real world, in the risk neutral world. Why this is important? Well, if we were successful in transforming the values or the payoffs into a world where investors are risk neutral, although it's a hypothetical world, but still we assume that it exists. We know that investors, according to their risk preference, we can classify them into 3 types of investors. Either investors are risk averse, which means that investors require a compensation for entering into any risky investment. So they need a risk premium. And we know that investors are risk neutral, which means investors don't really care about risk. Or what they need when they enter into any risky investment is to at least get the risk-free rate. If they can get higher, they will be happy, but they don't really care about risk. All what they care about is the time value of money, and they will require to be compensated by earning the risk-free rate. And the third type are risk lovers or seekers. And these types of investors, they pay to take risk. And mostly we see these type of people in casinos where they gamble, and usually on average they lose. So they know that they will lose, but still they want to take the risk. So if we were able to transform the option payoffs into a world where investors are risk neutral, then to find the value of the option today, all what we need to do is determine what's the expected payoff of the option, and then we discount it using the risk-free rate. Because as in the previous scenario, when we discussed the riskless portfolio, the most difficult part that we face in finance is determine what is the proper discount rate. If we were able to transform the payoffs to be in a world where investors are risk neutral, then we don't really need to care about the proper discount rate, because we can use the risk-free rate as a discount rate to find the value of the option today. First step, we determine what's the expected payoff in the risk neutral world. Then we determine what's the price of the option today by discounting the payoff, the expected payoff in the risk neutral world using the risk-free rate. So again, P is interpreted as a probability of an up movement in a risk neutral world, and 1 minus P is a probability of a down movement in the risk neutral world, where anything could be discounted using the risk-free rate. So it acts as a probability. However, it's not a probability. This is not how we calculate probabilities, right? Because I have inputs here, and these inputs are something that we observe, some characteristics of the stock that we observe, and from these characteristics we calculated P. It doesn't really represent a probability. Now, the binomial tree shows the general results that the value of a derivative can be assumed to be the expected return on the underlying asset. It is based on the assumption that the expected return on the underlying asset is the risk-free rate. And if you want to discount that expected return, we use also the risk-free rate. So there are two main features of the risk-neutral world. The expected return on the stock or any other investment is always the risk-free rate, which means if I want to find what will be the expected value of the asset in the future, all what I need to do is to compound using the risk-free rate. Once I did this, then I can find what it would be the expected payoff of the option, and now I can get the price of the option by discounting the expected payoff using the risk-free rate. So if the probability of an up and down movements are P and 1 minus P, then for the stock, the expected stock price at time t is S0 times e to the power of RT. So we kind of compound the stock price using the risk-free rate to get the expected stock price. And the expected future payoff of the option is P times FU plus 1 minus P times FD. Sorry, it's not U, it's a D. So this shows that the stock price earns the risk-free rate, and the value of the option will be basically the expected payoff of the option discounted using the risk-free rate, which means that P times FU plus 1 minus P times FD times e to the power of minus RT. Of course, we are assuming here R is continuously compounded rate. Okay. Let's apply the previous example of the one-step binomial model that we saw at the beginning of the video on the new version of the call option price. So to be able to proceed, first we need to agree on what is the factor U and what's the factor D. Now we know that the price of the stock at time 0 is 20, and the price of the stock when it increases, when it goes up, is 22, which means the factor of U is 1.1. So 20 times 1.1 will give us 22, and 20 and the price when the stock goes down is 18, which means 20 times 0.9 will give us 18. So the factor U is 1.1, the factor D is 0.9. Now we are ready to calculate P. So all what we need is the risk-free rate, the time to expiration for the option, and the factor D and the factor U, and we will get P is equal to 0.5503. Now, we know that uh, 20 times e to the power of 0.4 times 0.25 will give us the expected stock price after 3 months, which is also similar to 22 times P plus 18 times 1 minus P, and that will also give us the value of P, which is 0.5503. So this is an alternative way to calculate P, right? Now, we have P, we have U, we have D, and all what we need is to find what is FU and what is FD. FU is equal to 1, and FD is equal to 0. So we can calculate the price of the option today. So F, we know that if we want to remind ourselves with the formula, F is equal to P times FU plus 1 minus P times FD times e to the power of minus RT. Now, P is 0.5503 times 1. 1 minus P is 0.4497 times 0, which will be equal to 0. So we multiply this by the discount factor, and we will get the value of the call option is 0.545, which is exactly the same value we found using the no arbitrage argument or the replicating portfolio. Now, we want to discuss a little bit or make a comparison between the real world versus the risk neutral world. So P is the probability of an up movement in the risk neutral world, not in the real world. And it is not the same as the probability of an up movement in the real world. Now, when the probability of an up movement is 0.5503, the expected return on the stock and on the option is the risk-free rate. However, if we are in the real world, the expected return on the stock, let's assume that we were able to successfully find the expected return on the stock, and we found it's 10%. So the probability of an up movement in this world will equal to, well, we do the same setup, we find the expected price of the stock, and then we solve for P star, which is an up movement in the real world, or probability of an up movement in the real world. So 22 times P star plus 18 times 1 minus P star should equal to the expected stock price, given that we assume the expected return is 10%. And if we solve for P is equal to 0.6266. Now, the expected payoff from the option in the real world is, well, P times 1 plus 1 minus P star times 0. So P star times 1 plus 1 minus P star times 0 will give us 0.6266. Now, we found the expected value or expected payoff of the option in the real world. What's the next step? The next step is we discount this expected payoff to today's value to find its present value and find its price. Now, let me ask you, is the option in the real world, is it a risk? Is it a risky asset or it's a risk-free asset? Well, if you just look at the payoffs, sometimes it is possible that it will be 1, it is possible that it will be 0. You can immediately conclude that it is a risky asset. It is a risky asset. Now, here where we get stuck. Okay, which rate should I use to discount the expected payoff? Should I use 10%? Well, the 10% is the expected return on the stock. It is not the expected return on the option. Option is a different asset or a different instrument. Here where all attempts in the past to successfully discount its value to today's value failed when we are dealing with the real world. And here where this transformation to the risk neutral world made a huge difference in solving this problem. Now you can see that by examining the formula here, that the expected return on the stock does not enter in any way in the formula. Right? You can see that the formula does not involve any factor or any variable that is related to the expected return on the stock. All what we need to know by how much the stock price can go up and by how much the stock price can goes down. And this factor by itself is important because, or it is related to an important variable related to the stock. Can you think of what is this variable? Now, the U and D is similar to the possible prices for the stock, right? So, and what really describes this movement in the stock or the range of possible prices for the stock is the volatility. So the result or the fact that we conclude is that when we are valuing the option, the probability of an up and down movement in the reward are irrelevant. We don't really care about them, right? And this means that the expected return on the stock in the real world is also irrelevant. All what we need to know, what is the volatility of the underlying stock? What's the current stock price? What's the payoff of the option? What is the risk-free rate? And we will, if we have all these factors, we will be able to find the price of the stock today. Sorry, the price of the option today. Okay, let's move one step ahead by examining a two-step binomial tree. So the one step is a awfully simple model. So let's look at a little bit more complicated version of the binomial tree, which is the two-step example. Now, in the two-step example, we still have the current price of the stock is 20. The strike price of the option is 21. R is equal to 4%. Now, what's different here is that each time step is 3 months. So this is 3 months. And this is also 3 months. Which means the option will mature after how many months? 6 months, yes. So since the option will expire after 6 months, now the whole idea behind the binomial tree is what? We want to simulate the possible prices of the stock. Based on the possible prices of the stock, we calculate what will be the expected price of the option. And once we calculate the expected price of the option, then we discount it back step by step to get its price today. So that's the general picture of what we are doing in the binomial tree. First, simulate possible prices of the stock until we reach the maturity of the option. Then we calculate the expected payoff of the option at each level of the price of the stock, and then we discount them back to today's value to find the value of the option today. Okay, now we know these are called the terminal values of the tree. So at the terminal values of the tree, we calculate the payoff of the option at each level of the stock price using the payoff is equal to the maximum between ST minus K or 0. So here we will have, now also it might makes our job easier if we name each node of the each node of the tree. So here this is referred to as SUU, and this is the payoff FUU, and here it's the price of the stock is SUD, and the price of the or payoff of the option is FUD. Now the last one is SDD, and the payoff of the option FDD. Now also the SUU will tell us how we can reach this price. So we multiply first 20 times U, where we'll get 22, and 22 times U again to get the price of the stock. When it increases first and increases in the second step, we will get 24.2. At here, we assume the price of the stock went up by multiplying S0 by U, and then we multiplied by D to get the price if the option if the stock went up first and then went down in the second step. We will get 19.8. At the lower branch of the tree, we multiply 20 by D, we will get 18, and then we multiply it again by D one more time, and we will get 16.2. Now our job is to estimate what will be the payoff at each price. So we can easily conclude that the option is in the money only when the price of the stock is 24.2. When it's 19.8 or 16.2, the call option is out of the money, so the payoff will be 0. The payoff when it is in the money is 3.2. Now our next step is to calculate what will be FU and FD, and from FU and FD we calculate the value of F. How we calculate FU and FD? Well, for any node at the tree, always F is equal to P times FU plus 1 minus P times FD times e to the power of minus RT. Now if I have here, if I'm dealing with, for example, FU, then this will be FUU, FDU, or UD. They are the same. If I have FD, then it's going to be P times FUD plus 1 minus P times FDD to the times e to the power of minus RT. So the general formula is always F is equal to P times FU plus 1 minus P times FD, all times e to the power of minus RT. So for example, if we have here FUU, then this will be FUUU, and here will be FDUU, for example. Okay? Then what will be FU in our case? Well, we know the probability. Let's just change the color. So the probability is 0.5503 times 3.2, yes, 3.2 plus 0.447 times 0 times e to the power. Now when we are discounting, important here that we remember that we only discount for one step, so we are not discounting for the whole t, the time to expiration of the option. That's why from when we are using 2 steps or more, we don't use times t, we multiply by delta t, and delta t is basically how much time each step represents. Okay, so since each time represents 3 months, so we have 0.04 times 0.25, and that will give us 1.7433. For FD, since we're multiplying P and 1 minus P by 0, it will also equal to 0. Now we have the inputs to get the value of the option today, which is FU and FD. So P times 1.7433 plus 1 minus P times 0 times e to the power of 0.04 times a quarter will give us, so this is the formula, will give us the price of the call option is 0.9497. That's why in the slide here we did not waste time calculating the value of the at node FD, because it is going to equal to 0 since the inputs for this part of the tree are equal to 0. Okay? Now, what if we are dealing with a put option? So all the examples that we looked at before, they were related to a call option. What if we are dealing with a put option? Well, if we are dealing with a put option, the whole mechanics of constructing the binomial tree are going to be the same. Nothing will change except for calculating the payoff at the terminal values of the tree. Now we know that the payoff of the put option is the maximum between K minus ST or 0. Especially we are dealing with a European call option. Okay? So when the first step we calculate the prices of the stock in the tree. In this example, U is equal to 1.2, D is equal to 0.8, R is equal to 5%, which means P is equal to e to the power of 0.05 times 1 minus 0.8 divided by 1.2 minus 0.8, which gives us P is equal to 0.6282. So we calculated P. Now we get what will be the price of the stock at the terminal value. So 50 times 1.2 will give us 60. 60 times 1.2 will give us 72. I want to get the price of the stock here. I can either multiply 50 times 1.2 will give me 60, and then times D will give me 48. Or 50 times D will give me 40, and 40 times U will give me then 48. The final price is 50 times 0.8 times 0.8 will give me 32. Now when the price of the stock is 72, the payoff of the option will be 0 because the option will be out of the money. When the price of the stock is 48, then the payoff, since the strike price is 52, the payoff is going to be 4. When the price of the stock is 32 and K is 52, then the payoff is going to be 20. So we have now all the inputs we need. We are ready to calculate. So we have F U U, we have F U D, and we have F D D. Now we are ready to calculate F U and F D. Then we will be able to calculate the value of F. Okay. So let's quickly remember how we can calculate the value of FU. FU is equal to what's the probability? 6282. So it's 0.6282 times 0 plus 1. Just a second. So 1 minus P is going to equal to 0.7. 3. (718) times 4 times e to the power of minus 0.05 times 1, because each time step is 1 year, so times 1. This will give us 1.4147. How about FD? Well, it's the same thing. So FD is equal to 0.6282 times 4 plus 0.3718 times 20 times e to the power of minus 0.05 times 1 will give us 9.4636. Now we have FU and FD. Using the same formula, we will be able to get the price of the put option today, which we found equals to 4.1923. Now all the options that we dealt with, we assume they are European. What will happen when the option we are dealing with is an American? Now, the major difference between American options and European options is that in an American option you can exercise anytime before the maturity date, including the maturity date or the expiration date. How we can incorporate this when we are trying to value a put option using the binomial tree? Well, the construction of the tree will be exactly the same. We simulate the prices of the stock. We estimate what will be the payoff at the terminal values of the stock, and then we determine the we discount the expected payoff one step backwards. At this step here, we will do one additional step. What is this additional step? Now, we'll assume if the price is 60, when the price goes up one step, we will examine whether the option is in the money or out, and if it is in the money, we will take into account the possibility that the option will be exercised early. So since the price of this stock is 60 and the strike price is 52, if the price went up one step, it will be out of the money, so there will be no early exercise. But if the price went down to 40 and the strike price is 52, then the option is in the money, and the new FD that we will include to calculate the value of F will be the maximum of two values. One is, so for an American, put the FD in our example here will be the maximum between two values. One is the calculation of FD the normal way, which is 0.6282 times 4 plus 0.3718 times 20 times e to the power of minus 0.05 times 1, and another maximum operator between k minus s, that's not st, k minus s and 0. So we will calculate if the option is going to be exercised early, and we are going to calculate the discounted payoff one step, and the maximum between these two values will be our FD. Here it is equal to 12 because it's 40, 52 minus 40, we have 12, and this, as we saw, it was 9 point something, so the maximum will be 12. Now this will be included in the calculation of F. So our FD now will be F is equal to 0.6282 times 1.4147 plus 0.3718 times 12 times e to the power of minus 0.05 times 1 will give us now the price of the put option. Now increase what happened when we assume the put option is American. The value of the option increased from for a European 4.19 to for the American 5.89, which is expected because we expect the price of the American option to be higher than the price of the American option. Sorry, the price of an American is higher than the price of the European. Okay, now next here we want to discuss a little bit about the about delta. Now delta, it turns out to be one of the important Greek letters that are option traders look carefully at whenever they're trading options to manage their option holding. Now in chapter 19 there is a whole chapter that is dedicated to discussing the Greeks, but it's outside the scope of our course, so we will not be focusing a lot on it. Now delta, as we learned at the beginning of the video, is the ratio of the change in the price of the stock to the change in the price of ratio of the change in the price of the stock option to the change in the price of the underlying stock. So it measures the sensitivity of the option price to changes in the underlying stock price or underlying asset price. It also has another function. It tells us if you want to create a riskless portfolio, what is the number of stocks we need to hold or we need to enter, take a long position for each option we shorted. So this is the benchmark. When we short one option, how many stocks we need to hold. Now if we examine delta from one node to another, we will find delta for the option will change from one node to another node. Now, what do you expect the value or the possible ranges of delta for a call option? Well, when the option is deep out of the money, which means there is no chance that the option will be exercised, then there is no point of holding the underlying stock. So delta will be 0. When the option is deep in the money, which means there is 100% certainty that the option will be exercised, so to have a riskless portfolio, then we need to have one stock. So the possible range of delta for a call option is between 0 and 1. How about for a put option? What do you think is the possible ranges of values for delta for a put option? Now, unlike in the call option, for a put option, to create a riskless portfolio, I need to have the same position in the stock that is similar to the position I took in the put option. Why? Because if I took an opposite position as in the call option, then it will be impossible that I will create a riskless portfolio. To be able to create a riskless portfolio for a put option, well, if I took a long in the put, I need to also have a long in the underlying stock. If I took a short in the put, and since delta is based on taking a short in the put, I also need to take a short in the underlying asset or underlying stock. So for this reason, delta will be 0 when it is deep out of the money. There is no need to have the stock in our position. And if it is deep in the money, then if I took a short in the underlying stock, if I took a short in the underlying in the put option, I need to take also a short in the underlying stock, which means I need to take a -1. A -1 refers to the case that I take a short in the underlying stock. Why -1? Again, because the benchmark for calculating delta is that for each option I short, what is the number of stock I need to hold? So because I'm dealing with the put option, and the position in the put option should match the position in the underlying stock, if I took short in the put, I need to take a short in the underlying stock to be able at some point to create a riskless portfolio. Okay, now we learned that the only variable that we need to estimate in the binomial tree is U and D. And in U and D, one way to find U and D is to match it with the volatility of the underlying stock, because the difference between U and D in a way represents the volatility of the underlying stock. So there are different versions of calculating U and D. The approach that Cox, Ross, and Robinstein followed is to define U to be e to the power of sigma, the volatility, the annualized volatility of the underlying stock, times the square root of delta t. And delta t again is the period one step represents. In the put option, one time step was 1 year. In the call option, one time step was 3 months. And D is basically either 1 over U, or it is equal to e to the power of negative sigma times square root of delta t. Okay? Now, remember, when we were dealing with the risk neutral valuation, we relied on U and D. and U and D is based on the volatility of the underlying stock. Now, is the volatility of the underlying stock something that we observe in the real world or in the risk neutral world? Well, we don't observe really the risk neutral world. We just an estimation. It's a transformation, mathematical transformation that we are doing. But the volatility that we estimate from actual stock prices is the volatility that we observe in the real world. Then how can I use the volatility from the real world in the world where I am assuming that investors are risk neutral? Well, Girzanov provides us with a theorem that helped solve us a great deal of headache, and he proved that the volatility in the real world is the same as the volatility in the risk neutral world. So if I measured the volatility in the real world, I can use it to build the tree of an asset in the risk neutral world. Now, one issue we need to discuss also before we conclude our discussion of chapter 13 is what would be the proper number of steps? Well, using 1 or 2 steps is an awful unrealistic simplification of the real world. We can, if we monitor or observe the number of trades that take place in the real world, it could be thousands or tens of thousands in a period of 1 month or 3 months. So assuming a 1 step or 2 step is far from reality. However, practitioners sometimes use a larger number of steps to be closer to the reality. Now, some people use 30 steps, some people use 500 steps, but at least we should use 30 steps to reach something that is closer to closer to the reality. Now, this chart here shows how the price of the option is sensitive to the number of steps. So as we increase the number of steps, we find that the value from one step to another varies dramatically, significantly. But as we increase the number of steps, so until after 60 and 80 and 100, now the differences or the sensitivity of the number of steps becomes smaller and smaller until the difference is not that significant. Okay. Sometimes if you want to do a double check is to know how many you need to verify that if your tree is properly constructed, then if we have n time steps, then we will have n plus 1 terminal stock prices, and we will have 2 to the power of n possible stock price paths. So if we want to just examine, is that true? Well, in the 2-step scenario, we have here 3 terminal values, which is 2 plus 1, and we have, so how many paths we have? We have one, this is one path, this is another path, and this is a 3rd path, and this is the 4th path. So we have 4 paths for the 2-step, which is equal to 2 to the power of n, which is 4. Okay. What if we are dealing with assets that are other than a non-dividend paying stock? For example, if we are dealing with options on stock indices or currencies or futures, then the basic procedure for constructing the tree is the same, exactly the same, except for the calculation of P. So the general format for P will be A minus D divided by U minus D. And A for a non-dividend paying stock will be e to the power of r times delta t. And why we use delta t here? Because when we have more than one step, we need to discount, or we need to look at the probability for only one step, and one step is represented by delta t. If we are dealing with an option on a stock index, then A is equal to e to the power of r minus q times delta t, and q is the dividend yield on the index. If the underlying asset is the foreign currency, then it's the same as the stock index, except that instead of q we have rf, which is the foreign risk-free rate. And if the underlying is a futures contract, then A is equal to 1. So that's it for our discussion of chapter 13. I hope you find the material useful. Thank you for watching. Assalamu alaikum.